Good evening and welcome to third episode of our masterclass on cap table. We were discussing a very relevant point to say that when we started off with our first episode, we were in our half sleeves with the ACs on, and by the time we are culminating this series with the third episode, we are in our at least the sweatshirts and the blazers. So welcome all to the masterclass on our cap table. My name is Sambhav Mehrotra. I'm a chartered accountant, and I would say my specialty and my learning curve has been to understand founder mindset. With me is Akash Goyal and Nitin. Akash, maybe you can introduce yourself yet again.
So I'm a company secretary working in the startup ecosystem in the secretarial and legal domain over last 10 years.
And I'm a chartered accountant and a registered valuer. I help startups in financial modeling, valuations, cap table issues, all those things.
So good to have you again. It's been a good ride in the last two episodes where we've built up a whole startup cap table from scratch. So we'll just do a little recap of our last two episodes and then move into a topic where we had a good traction as compared to last two topics that we have chosen. So we started off with a company with two co-founders where I invested first check of 50 lakh rupees as an investor. And we talked about how the cap table will take shape. Little bit touched upon ESOP, which is our topic for today. We talked about dynamics of definitive documents like SHAs, SSAs, and all other term sheet related documentations and terms. And we've entered into a fully drafted cap table, what we were calling as fully diluted cap table. And we were kind of looking at a cap table, which is, say, after Series A or Series B, how does it look like? So I think we've covered that journey. We covered that story where we drafted a cap table, but we've kept this one topic separate because we knew that the traction or the interest in this one topic would be phenomenal, the way the Indian startup ecosystem is evolving. So unfortunately, that slide which I have been projecting in some workshops, I will not be able to present it. But there is one slide that I've always used, which give reference to Alibaba's IPO. So there is a photo of Jack Ma with the lady, and she started off as a very standardized, maybe an executive role, executive assistant role. And she ended up with maybe 300, $400 million of wealth with, say, about 0.2% of ESOPs. So a phenomenal first slide that I always start off with. And we are not just talking about wealth creation here. Of course, that's one part of ESOPs. But then how does it look like from all angles? Founders, investors, and of course, employees. So let's just start unfolding that story. And maybe it's a recap of our first episode. So let's go back. Why ESOPs in first place? What are ESOPs and why are they needed?
Okay. So the answer is pretty simple. When we say why ESOP, founders themselves cannot build a company. They can probably start a company, but reaching and making it operational at a higher level would require participation from all and sundry, including employees. So ESOP is basically a ownership participation tool for employees, where company is saying that you stay with us, you work with us, build this thing, and then participate in the value creation, as you said. Recently, a lot of IPOs are coming for tech companies, starting with Mamaearth, Nykaa,
ATM. Let's just name it. Yeah.
and then Ola, and very recently Swiggy as well.
Yeah.
And all the news outlets, they covered one story invariably that was about ESOPs and how employees of Swiggy, Zomato, all these companies, they got benefited out of the ESOP policy. So what happens is, once you are raising funds, you go to investors and raise funds. Investors themselves will kind of push you to have a ESOP policy in place. It simply means that they're asking you to make employees a partner in your journey. Right. So what you do out of the ownership structure, you set aside certain portion of that, which would be given to employees. So you earmark certain percentage, which would be used for, giving grants. I'm using certain jargons here. We will explain those jargons later on. But you can say the company will use this pool and it would be distributed among employees in future. So that is what ESOP is.
Interesting. So we talked about this percentage in first episode. We'll come to that later. But Akash, of course, we've kind of diverted this ESOP discussion from a startup framework landscape. But is it just startups where ESOPs are kind of big name, or is like it's a very standardized thing which exists across corporate framework?
Usually it's a startup ecosystem, but yeah, anywhere you can find it from SMEs to startup, then from or to a listed entities. Usually, what we have seen, and since we have been working majorly in the startup ecosystem, we usually see this as a incentive plan for the employees, where the founders do not have that big pockets to pay to retain the high talent, and then they usually offer the ESOPs, like Nitin had mentioned, the worth of that ESOPs. So, yeah.
I think one interesting differentiation. Yeah, go ahead, please.
See, I mean, you have to look at overall industry growth as well. So, if you look at 70s, 80s, any business to succeed, you would need certain M's. You must have heard of these M's, right? Money, man, machine.
Capital and labor are the two
Right.
prominent
Right.
levers. Yeah.
Just look at the trend. 40 years, from today, we were at a stage where money was the key to success. It was not manpower. The products were physical in nature, not driven primarily labor. You definitely needed skilled labor, but still, the key input for the business to succeed was money.
Capital. Yeah.
That money used to come from banks, investors, etc. So there was no question of giving ESOPs because the success was not based on employees' strength. Now, today, 2014, 24. Money definitely is not a problem, right? The capital markets are more mature now. The AIF space where a lot of funds are getting registered, money is not a question now. The question now is manpower. So how do you compensate that? Earlier you were paying interest. Now you're paying through ESOPs.
Very
so it's more of a, trend.
Very interesting. So before I go to the next point, what I was trying to highlight here was, I think startup ecosystem is the only landscape where an office peon per se as a position can end up being a crorepati. We've seen many stories. If I'm recalling correct, Citrus was one company that got acquired. Infosys. They had, yes.
Infosys was first.
Yeah, Infosys was first. So the many use cases where even early stage employees, whatever position they are working at, they might be eligible. But as the organizations start getting matured, there is a level beyond which ESOPs get granted or allocated, but it's not a company that ESOPs can be given out. So taking this forward, who are the eligible folks? Where does this ESOP get allocated? Who all are eligible for ESOPs? Maybe you can just throw in some light on this.
So technically, the law says anyone who is into the permanent employment of the company, they are eligible. Either it is full-time director or a junior level employee who is basically in the permanent employment, who is on the payroll of the company, right? They are eligible. So yeah, it is not just to retain high talent or say the high level employees. It can be allocated to the junior staffs as well if they are on the payroll on the company, plus the permanent employees. So this is the technical definition of the law.
Got it. But can we give ESOPs to say consultants or non-employees, because the word itself says employee stock option program or plan?
No, consultant and the advisors are not allowed.
So let's pick this topic in the end, because I'm sure many folks have sent this question of how can I give advisor equity and all. So we'll come to that, but let's just also take an example of a prominent structure which is shaping up, and now it's the reverse also, where there is holding subsidiary relationship. Specifically, so far we've seen people externalizing and then going to Singapore or US. Now it's good story that people are finally realizing, chalo wapas aa jao, yahi IPO लाएंगे, and it's flipping the structures and all. Now, in these kind of structures, how do you then figure out the eligibility? Are subsidiary employees also covered? Are they not covered? Is it jurisdiction based? How does that work?
It basically all goes with your ESOP schemes, right? So if in the ESOP scheme, the company has covered the subsidiary, the employees of the subsidiary and the employees of the associates company, right? So it all goes with your ESOP scheme, that how your ESOP scheme is being drafted and covered, covered the companies like your associate and the subsidiaries. Even if the subsidiaries are outside India, right? The employees of that company can also be eligible to get the ESOPs of the parent entity, which is in India. So it all goes with your ESOP scheme.
So you touched upon ESOP scheme. We'll go
Yeah.
into that detail. But before that, if you're able to hear us properly, please let us know where you're joining from. Of course, our team is joining from our office as well. And I'll request presenter to, you can switch off the sharing when it's not needed. So you talked about ESOP scheme. So let's just go into a little on administration before we actually go into the cap table and valuation.
Right.
How does an ESOP scheme come into existence? What are the secretarial compliances? What is the right time? Maybe you can holistically cover and I'll keep throwing questions.
Sure. So just taking that example,
Two
right,
co-founders.
where we started.
Yeah.
Two co-founder, they started the business. They are now keep hiring the employees, right? So again, there may be some investors in between where the investor can ask you to basically put the ESOP policy in place, even if there are no employees, right? So yeah, that is the time where the company will need to draft a ESOP policy, will have to implement that ESOP policy, do the relevant compliances in the Companies Act or in the SEBI laws, right? And then basically keep allocating the grants, and then vesting and exercise will follow. So talking about the framework, ESOP, generally I divide into two parts. First is basically drafting the ESOP scheme, then doing the secretarial compliances, right? The second stage is where the admin or say HR rules come into the picture, where the grant and vesting and the exercise usually happens. So in the first part, the company will need to draft the ESOP scheme, which may have the different points, starting from the purpose. In the ESOP scheme, you may find various clauses, like starting from the purpose, we'll need to define the purpose, we'll need to define the number of options, or how much pool is being created. It is needs to be stated. Then definition part, then how the ESOP scheme will be administered across the company, right? Who will basically run that ESOP pool, correct? Then there are clauses which basically governs the provision of grant, vesting, exercise period, grant period, lock-in, cliff. All of these clauses are to be included. Then some special clause can also be included, like drag along, tag along, buyback. All of these becomes the part of the ESOP scheme. And once this whole been drafted, right, and then the company can go to the board, take the board approval, then go to the shareholder, take the shareholder approval, go to the ROC, do the MGT14 filing, and then once that filing is done, your ESOP is officially been adopted on that day. From that day, you can now the implementation stage comes to the picture, where you can ask your admin or say HR team to basically give the grant letter, which is just nothing, just the offer to the employee that we have been offering you X number of options of this company, of our company. Please share your acceptance or no to it. That grant letter, and then there is a grant period, which is basically the period which is being given to the employee to accept that grant, right? That is called grant period. Grant के बाद start with the vesting period. Vesting is again the vesting in which the employee will get his ESOPs.
Yeah, so maybe we'll touch upon the terms, because for a moment I just empathize with the founder and I realize I might just get up and say, "Chalo, go karne denge."
Yeah.
So what I have understood so far, if I have to speak from a layman language, is if I want ESOP in my company, I just cannot go haywire. And I'll come to Nitin when I say haywire. We need a document called ESOP scheme, which needs to be adopted through a secretarial process.
Right.
Once we have done with that process, we can go ahead and do administration of that ESOP. Correct. By leveraging our HR function, who will give the grant letters. We'll come to that.
That's correct.
But just bringing Nitin in between, we talked about valuation. That ideal process is first we do 5-year projection, and then we do a valuation with the founder, and then the founder goes to an investor with that valuation report and negotiate. Right. But unfortunately, it happens the opposite, where founder comes back or investor comes back and say, "This is the amount we are investing. This is our percentage. Now this is the valuation we need," and we start reverse. Now, in your practical experience so far, have you ever, and how frequently you have seen companies which have actual ESOP policies in place, and then they are coming to you saying, first do the valuation and then we do the grants? So we'll touch upon how it is done, but my question here is, practically, how is it happening? Because The valuation is one step which is kind of concretizing ESOPs, and it comes at a very late stage.
Right.
But when it comes to you, do you feel that people do follow this process, and if not, how does it happen?
See, in Hindi there is a adage. It's called "जिसका काम उसी को साजे और करे तो डंडा बाजे."
Absolutely.
The idea is these are tech peoples, mostly. I mean, and their primary focus is on operations, business, and all those things. Secretarial things, compliance things, they somehow become secondary.
Low hanging fruits.
Right. I mean, so practically how it works, once you are raising funds, you would have a valuation then, right? So as far as valuation for ESOP is concerned, at least, that is not a major question because you already have a valuation in your mind, which has been kind of agreed upon with the investors. The same valuation would be used for ESOP grants as well. The valuation of ESOP is not an issue. The major problem, as you rightly mentioned, is about ESOP policies. So what founders generally do, they agree on a certain percentage of ESOP pool. That means they are setting aside a part of their capital to be given to employees in future. They do that part very well. No issues in that. Now, when it comes to actually giving those grants to employees, this is the point where they falter. They don't actually create a ESOP policy. Employees keep on chasing them and they keep on deferring grants. And at one day, suddenly they will wake up saying that, we don't have a ESOP policy in plan. Let's implement it.
Mhm.
Ideally, that should have been done like 6 months back or 1 year back. So all these compliances have already got delayed. His job would be difficult, right? We in any case, we come at the year end time, when auditors are asking for a ESOP expense computation, valuation, etc. So let's say you can say in 50% of the cases they forget to implement this ESOP policy.
Interesting. So let's go back to the implementation. What are the ways to administer? I've heard some say they have a trust route and there is non-trust route. What are those? How does that function? What is the preferred for startup ecosystem?
So ESOP can be implemented through the option route or through the pool route, which is called ESOP pool, right? And that can also be implemented through a trust route. So talking about the pool, we have just elaborated the same, right? Where the company will need to create a pool, where the company will need to create a scheme, right? And then there is a board which can administer the whole ESOP policy. The trust route is usually to be followed by the bigger companies, or say the companies which have the higher number of employees, say 1,000 employees or 2,000 employees, right? Although there is no defined thing, but considering the complexities of a trust route, right? If you are going through the trust route, right? That's where the trust route becomes unfavorable for the startups who have just started the operations, or maybe who have just started their hiring, right? So trust route is little complicated in terms of opening up a trust will take you say approximately 1.5 months or 2 months time, right? To basically have a trust in place, along with the administrator of that trust, right? Will also be a complicated process for the company who is just starting the operation or just started the company. So yeah, there are two ways, but yeah, trust route is more favorable for the companies where the number of employees are higher.
Understood. So if my understanding is correct, what you are telling us is through trust route, you have actual allotment of shares and liquidity of those ESOP shares is available.
That's
because as and when you want, you can transfer. But in a pool, it's more of a assumption, or it's more of a future oriented event that, oh, we are giving you a grant, but the allotment will actually happen, or the physical shares or demat shares or whatever shares, they come into picture at a later date. Once we'll come to those terms, the exercise happens.
That's correct. So ESOP pool, ultimately the dilution in both the case will happen to all the shareholders, right, who are on the cap table. Either you create the ESOP pool or you go through the ESOP trust, right? In an ESOP trust, the actual shares will be held by the ESOP trust, right? And as and when the exercise will happen, so we'll talk about that what is exercise. As and when the exercise will happen, the employee will apply to trust, and trust will basically transfer their shares to the employee. In the previous case where the company has created ESOP pool, right, there is no physical share in place till that till the time employee exercises right and apply to the company to get those shares. So this is just a notional pool in the cap table. It will also be not shown in your financials. It just come as a note to the share capital and reserve note right in the balance sheet. So your paid up capital may not change by the ESOP pool, but your cap table will definitely change.
Right.
So all the shareholders who are on the cap table will definitely want to see that how much they are getting diluted because of the ESOP pool. Because benefit of someone, right, is basically the loss of the other one.
So what you're saying is for startups, it's better that non-trust route is favorable.
Yes, for the young startups, correct. That's correct.
Understood. Got it. Now let's move forward into little practical aspects. Have you ever seen co-founders being brought in terms of ESOPs?
Yes.
And
there are
how does
possibilities.
that mechanism work?
So the mechanism is same, right? If the co-founder is coming as a full-time employee to the company, right? He will joining the board, or maybe he'll be taking some position, right? XYZ position. But he needs to come as a full-time employee of the company. Yes, it is very much allowed, and it's a normal process. Like you do for your any of the employee, you can give it to the co-founder as well.
Interesting. So going back to Nitin, before we go into a real example to understand terms,
Right.
you would have seen multiple cases of co-founders coming in at later dates. So suppose in our case, the company got started and say in 2 years time, third co-founder wanted to join in. In that case, have you seen secondaries more prevalent, or have you seen ESOPs more prevalent?
It's both. Primarily, it's secondaries. See, co-founders are generally people who have already proved their worth. So they don't want to wait another year to get the shares. So they want some kind of commitment from day one itself. ESOP route is fine, but the problem with ESOP is that there has to be a cliff period. That means, let's say if I grant you shares options today, you cannot have those shares, you cannot exercise those shares, until and unless you complete 1 year at least, as per law. Now these co-founders, they don't want to wait that long. So instead of going only through ESOP pool, they will get certain shares through secondary, and then will participate in ESOPs as well.
Got it. So you've touched upon so many terms. I think the best way to look at it is, let's use a real-time example. Instead of an investor, now I become the employee of that same company where two co-founders were there, and maybe say I'm joining as a first employee. Usually it is CTOs or CMOs or co-founders that are hired. But for a moment, let's say they are hiring a CFO, being a more prominent person to be there. And they've approached me to get onboarded. They don't have money, but they have requested me to take equity in the company through ESOPs. Now imagine a conversation happening between founders and me as an employee. Let's just start using those key terms in the scheme or this whole framework, and give me allot me an ESOP. And while doing that, let's just talk about what all terms we can refer to, beginning with say grant letter that we talked about. So maybe we can start off with it. How do you allot me an ESOP? So I need ESOP. My market price is 1 crore. They are giving me 5 lakhs. So I've asked him to give me 95 lakh worth of ESOPs. Right now, let's run through that process. And while we do that, let's just talk about all those terms. So what's the first step? Assume now they have a policy in place, which you have helped them adopt.
Right.
And I'm the first person joining as an ESOP employee.
Yeah. So for a founder, the founder will need to first value that how much worth of ESOP the company wants to give to that employee.
I want 95 lakhs.
So you may want any number, but it is just the discussion between you and the founder, right? You and the company, that what is the cash component which you are getting, what is the ESOP component which you are getting, and that whole becomes your CTC.
So probably the valuation that I come at becomes very prominent. So we'll come to that later.
Yeah. So the first stage is for the company to evaluate that how much worth of ESOP the company wants to give. Once that is being fixed, that can calculate the number of options which the basis on that valuation, the number of options will be calculated, right? and then the grant letter will be made by the company, which will state all the terms and conditions, like the vesting, what will be the grant period, right? So grant period means it will be a typically say 15 days or say a 1 month period where the company will give the offer to you. The company is granting 100 options to you basis on these conditions, right? And you will need to say accept or not accept the offer. So this is called the grant period. Then comes the lock-in. Then comes the vesting period.
So like in this case, let's assume you've given me 30 lakh worth of ESOPs
Right.
at say 5 crore valuation, and
Right.
I found it very lucrative that this
Right.
company is going to be worth 500 crores.
Right.
So 100x there becomes 5 crores in any case.
Right.
So then I've accepted your term. What document you are going to give to me?
That is the grant letter.
Grant letter is what?
Grant letter is the only document.
So is it the appointment letter and grant letter the same, or they are two different
It
documents?
can be same.
It can be same.
It
Okay.
can be same. If the company is ready with the policy, you have just joined us, right? And the company is giving you the employment agreement. So your employment agreement can have the grant.
So it can be embedded.
Saying
But is
the
it
grant
better to
details.
have it embedded, or you prefer those to be different?
It is a choice of the company that how the company has got their employment agreement drafted.
Right. So in this case, because the policy was there, you have given me an employment agreement and
Right.
I've accepted it.
Yes.
So that's my grant letter also.
That's your grant. That may be called as a grant letter as well.
Okay.
There is no regulation around it, but yeah, there is just the industry norms that the grant letter needs to go right to
Got
the
it.
employee before he accepts. So once you accept the offer, so let's just talk about, so in the grant letter, there will be the number of options. The company will not, usually the company doesn't mention the value, the worth of the options. It is just the discussion. It is just the verbal terms that you have got, say 30 lakhs worth of options, which is being drive to 100 options, right? 100 options being granted to you. You have accepted the offer. You have accepted the grant. That's called the grant date. As and when the company has made the offer, that's called the grant date. Now, the vesting period will start.
So will my joining date will also be a grant date, or they can be different?
They can be different. They can be different.
So what is mentioned as grant date within the document is
That's correct.
where from the vesting.
That's correct. In the grant letter, the grant date will be mentioned.
Got it.
Right. That date will be considered for your vesting period, for your exercise period. So the grant has happened, right? Now the vesting period will come into the picture. Usual standard vesting period, which we have seen 98% or 99% cases, is 4 years. So
Okay.
you are asking your employee कि आपने 4 साल दे दोगे आप मुझे, that is more than enough, right? Your expectation is balanced. Employee भी यही देख रहा है कि अगर मैं 4 साल दे रहा हूँ किसी कंपनी को, so that is more than enough.
But I just want 2 years because I come with experience. So
again, that is the discussion which is happening before you are getting the grant letter, right?
So I can have a differentiated vesting period as compared to my other peers who are joining with me.
That is possible.
So they can have a different vesting and I can have a different vesting.
Yes. Again, for that point, your ESOP policy needs to be flexible, right?
Got it.
As I mentioned previously, if it is allowed in your ESOP scheme, right, that the company can offer flexible vesting period, flexible exercise period to their employees, that is allowed. The board can administrate that, and the board can offer different vesting period, a different exercise period to its employee.
So far I've understood grant date, grant letter.
Yes.
I am getting a vesting period of
Correct.
2 years because that's what I negotiated.
Yes.
What else? Let's go ahead.
Okay. So in the vesting period, you will have to work with the company for 2 years. So now, since you have negotiated to 2 years, so there may be a point where 50% of your whole options will be vested each year, right? So your first year, so there is a 12 months mandatory lock-in, right? Lock-in, or say the cliff period, right? Where no vesting will happen.
So next term you're telling me is a cliff
lock-in or
which
cliff.
is 1 year mandated by law.
By law. So you cannot reduce it, you can increase it.
So if I leave after 8 months, I get nothing.
No, you will not get anything in the company, right? So your first vesting will happen only after expiry of 12 months. It cannot happen monthly. It cannot happen bi-weekly. No,
Got it.
Cannot. So your first vesting will happen after end of 12 months only. Suppose that the company can have monthly vesting provision in the ESOP scheme. Where
monthly.
If you are leaving the company, say after 14 months.
14 months, yeah.
14 months, right? So you will not lose the benefit of 2 months right? You will also get the benefit of 2
If it
months.
is monthly.
If it is monthly,
And
again,
what if it is half yearly?
goes on the month, goes on the scheme. If your grant letter is saying that the vesting is half yearly or say the quarterly, you will get the benefit accordingly. So
And even that can be different for different employees.
yes,
Okay.
again, that is
So my grant letter
If-
is the Bible for the ESOP.
for the employees. Yes, the grant letter is the Bible. For the company, the ESOP policy is the Bible, because the grant letter is ESOP policy is the basis of the grant letter, right? So we talked about vesting and then vesting period, right? And then comes the exercise. Once the vesting is done, now you have got the right to basically apply to the company to get the actual shares against the options, right? So you have been granted 100 options, not the shares. Initially, you have worked very hard in the company for 2 years, right? Now you have got the 100 options vested. Now you can apply to the company to basically get the shares, right?
ये share दे दो.
Correct. And that's where the excise period comes into the picture. So the company can have 1 month excise period, company can have 10 years excise period, company can have infinite excise period as well. So again, there is no law binding on it, but yeah, your ESOP policy will be definitely talking about it. That what is the generalized excise period for the employees?
So grant letter, grant date, vesting period,
Vesting period.
exercise period, cliff.
Correct.
I've understood all this. Now
Yes.
assume. So let's come to taxation later.
Yeah.
Now assume I exercise it after 14 months. 14 months of my vesting is done. Now maybe as an employee, I will want to time it, that what is the right time, maybe at year end. But whenever I do, what is the process? How should I do
So
it?
the process is the employee will need to fill one excise form, apply to the company that my 100 options are vested, and pay the excise price. That's trigger the excise price. So usually the company defines the excise price in the ESOP scheme itself. It may be ₹10, it may be 100. Again, no regulation around it. It will govern by the ESOP policy, right? Depending upon what is the fair value of the company's a share, the company can have different excise price for the different employees as well, right? So you are the first employee for say for my company, I may offer you the share of my company at ₹10. Someone, say Nitin has been joining, say after a year, right? I can offer that same share at ₹1,000 excise price. That is possible, right? So the excise price, again, your grant letter will talk about what will be the excise price for you to basically apply to the company. Also apply to the company that how much price you will pay to get those shares. So now your excise price will be 10. You have got 100 options. You are applying to the company, paying ₹1,000. Company will need to have board meeting, take the board approval, allot the shares to you.
So the whole allotment process starts.
File pass the reform, and then the 100 share certificate will be issued to you, and you will now become the part of the company's cap table.
And then I can sell that share in the open market and to get liquidity.
Again, for the private limited, you cannot sell in the open market. But yes, if the company has went to IPO, yes, you are very much allowed to sell it to.
So any other term that we've left? We've done grant letter, grant vesting, exercise, maybe something else that's left out.
So from the employee's perspective, these are the technical terms, and the employee should take care of all of these things. That what is the grant date, what is the grant period, what is my vesting period, right? For the founders, yes, there are a lot of things in the ESOP policy which I mentioned earlier as well. That there is drag along, right? All of those clauses comes into the picture. But yeah, for the employees, yes. What next the employee should need to keep in mind is that what is the right time to excise, and that's where the taxation and the valuations come to the picture.
Which is what I wanted to ask him. Of course, now I'm realizing ESOP itself could be a 5-episode series.
Yeah, I mean, one more thing here. I mean, from a founder's angle, since they are in the midst of everything, so they understand these technical terms. But I totally empathize with employees who have no idea about what we're talking about.
In fact, that's exactly what was going in my mind. Yes.
Yeah. So I mean, there are a lot of jargons. What happens if I don't accept those? I get calls from employees saying that I've been offered these grants. Should I accept? Not to anybody, it would seem like a no-brainer.
Right.
But they are looking at what if I accept and there is a liability on me?
Absolutely.
So you need to understand as an employee. I mean, now I'm going to talk about ESOPs purely from a employee's perspective, and I'm going to, kind of de-jargonize it. What exactly it is. If you've got like how many minutes we have got in our session?
We've half an hour left.
Okay, let me give you an example. It might take like 5-6 minutes, but it's something like this. Let's say from again, this is for the employee. Whosoever is joining us and who is an employee, they should, be able to understand this easily. Let's say World Cup is happening in India, right?
Mm.
And the final match is going to be in Kotla, Arun Jaitley Stadium.
Mm.
We don't know who is going to be in finals. The tickets have been sold out already. You may be interested in going to the finals depending upon who qualifies for the final. If it is Bangladesh, Pakistan, probably not. If it is New Zealand, India, probably yes. I don't know. So we don't have any visibility as to what final would be.
Mm.
But somebody in the DDCA who can get you a ticket. So the secretary of DDCA, he wrote you a letter saying that whosoever present this letter to the ticket counter, the ticket counter will give the ticket for say 5,000 rupees only, right? Irrespective of what is the market price. As you understand, as the final approaches, if India is looking strong, probably the final tickets would be selling at 25,000, 30,000, 50,000 maybe. I don't know. Right. And if it is a non-India match, the final, then probably less number of people few people would be interested in going to the finals.
Maybe at a loss. Yeah.
Right. But what you have got, you have not got the ticket. Since you knew the president, you have got a letter which entitles you to buy the ticket.
Yeah.
In future at 5,000 rupees, irrespective of the market price. Right. So now think about it. As the tournament progresses, India is not looking too good. We have lost our first match on league stage. There is lesser chance that India would make it to the final. Now in the black market, tickets have already been sold out. But since people are not interested in going to the finals because of India's performance, they are willing to sell their ticket for only 3,000 rupees.
Yeah.
Right. Now at this stage, as a holder of this letter, which entitles you to buy this ticket for 5,000 rupees, my simple question is, what is your loss?
Why would you buy?
You will not buy. As simple as that. Your loss is zero. You won't buy it. Because instead of buying ticket at 5,000 rupees from window, you will simply buy this ticket in the secondary market, at 3,000 rupees, even if you are interested in going to the finals. Now, Kohli is again, is a shining star. He brings India back in the tournament. Let's say now India is looking strong. We are in the semi-finals already. And the ticket in the black market is, trading at 20,000 rupees a piece. Now, what is your benefit or loss in this scenario? Till the time you don't buy a ticket, there is no loss, no gain. But if you buy a ticket today, you just have to pay 5,000 rupees. You can immediately buy the ticket and sell the ticket. Either you go to the final or you can sell the ticket in the black market for 20,000 rupees. Right? Now, let's say India is in finals now. Ticket is selling at 50,000 rupees a piece. What is your benefit now? 45,000 rupees. Yeah. Because if you have to buy this ticket in black market, you would be getting this ticket at 50,000 rupees. Now, because of that letter written by President or Secretary of DDCA, you can get the ticket at 5,000 rupees. Right? So your benefit is totally in the fact whether India makes it to the final or not. Now, I'm applying the same analogy to a company. You've got a letter from the president, that means founders of the company, which is a grant letter. The date on which you got this letter is the grant date. You have to wait for a certain time. That is the vesting period. The price that you're going to pay to the ticket counter is the exercise price. Now, your gain or loss will depend upon whether the company makes it to the final. Company is successful. Company is able to increase their valuation, through, whatever it takes. If they perform well, you will win, you would be gaining something. If they don't, you won't have any profits, but at the same time you won't have any loss also. You don't have to exercise those shares at a lower price. The company's share price is, already low.
Interesting.
Right.
So maybe let's just replace your India finals. Your analogies are always good. I still recall the paratha that we used in the first episode. In this case, what you're saying is replace your finals with, say, an option of acquisition or an IPO for a startup.
Exactly.
Right.
Exactly.
So if we feel that they'll create value and get acquired or get listed,
right,
that is our first stage
Right.
of decisive point.
right,
But you can even in real life, it's not just final. You can even go beyond, because if it's listed,
exactly,
you can still wait for more compounding to happen and more wealth to generate.
exactly.
Great example. Moving ahead, I think we've covered up basics of ESOPs, how it is implemented, what are the grant letter terms, and now I'm happy also that I got a ESOP worth 30 lakhs, which is now 5-6 crores. Let's go into real life practical issues, and while we do that, let's just also talk about valuations and vesting as well. Are there variations of vesting also? I mean, he talked about cliff period and then monthly vesting, quarterly vesting. But in terms of vesting analogy itself, are there more definitions that we should be aware of? Types of vesting?
We can throw more jargons into the discussion, but the idea is the companies might say that you have to wait for 4 years to get all the shares. You are entitled to 100 options, which you can exercise after completion of 4 years. Complete 4 years. If you leave before that, even 1 day before completion of 4 years, you will get nothing. That is kind of one-time vesting, right? But that doesn't work, right? We are not living in 60s, 70s where an employee joins and then finishes his career with the same company. Employees jump, and it's a normal thing for growth, etc. That's why these offers are not very lucrative for employees. To counter that, the companies will come up with a term called graded vesting. So they would say, okay, every year you will get 25%. So if you complete 1 year, you will get 25%. If you complete 2 years, you will get 50% of those options. Going beyond that, companies might also say that 1 year you have to wait. So for first 25%, you have to wait for 1 year. Beyond that, we will divide your remaining options, say 75 options, into 36 months. That is 3 years time, and every month you will some options will accrue to you, right? That is again a kind of graded vesting. These graded vesting could be quarterly, monthly, half yearly, based on what management wants to achieve.
Now let's go into the valuations, and then finally also talking about how does it all look on a cap table.
Right.
We've already valued the company when we raised money through private placement or when I invested as an investor.
Right.
Am I in need of another valuation report for ESOPs? If yes, why? What is the difference there?
Right.
In terms of how do you value it?
Right.
And key is, if I've just finished a private placement, I have just done a DCA valuation or any method.
Right.
Why do I need another valuation report for ESOP?
Right. Absolutely. So the questions can be divided into two parts. One is the share valuation. Second is the option valuation. As Akash mentioned, there is a kind of notional loss to the company, because company is giving 5,000 worth of share at 10 rupees. So there is a notional loss of 4,990 rupees. So accounting standards, they say that the company needs to account for this notional loss in the books. How do you account for that? You have to do a valuation. So this is where the valuation requirement comes in. So let's say you have just raised the funds. So value discovery is not an issue. Okay. You know what is the market price of my shares, because somebody else has subscribed to those shares at the same price. So we can take that price to be the fair value of shares. So that's the fair value, let's say 5,000 rupees. My exercise price is 10 rupees. So the notional loss to the company, expense for the company, is 4,990 rupees. I've simplified this thing, but there's some more variables which needs to be considered there. But that valuer will take care of that. Yeah. So you don't need not worry about it, but you can understand that that's the notional loss which should go into the books of accounts. Let's say you raise your fund 6 months, or 6 months ago, or last year. In current year, you're again making new grants. You're giving shares to new employees. Mm-hmm. At this point of time, you don't have any visibility of share price. For that, And to account for that, you need to have a fresh valuation to be done. Now, whether to do a single valuation for the whole year or to do two valuations, in a year, it is something which is a call, because again, it's a notional loss. Company is not paying anything in cash. So notional loss needs to be booked. For that, share valuation has to be done. The frequency of share valuation would depend upon your negotiations, your discussions with your auditors. So generally, auditors insist on at least having like two valuations in a year. Sometimes we can negotiate, and they agree on single valuation as well.
So in terms of methods, you're saying methods are same, or
yeah, methods are same. Methods are again, we are doing a value discovery here. Methods are same.
Understood. And if we have to say go into a little technicals here,
yeah,
where is all this terminology coming in from? Is it the company law or some guidance note, or which law is kind of governing all of this valuation?
So these, the valuation at a time of access, grant, it is coming from India's 102 and ICI guidance note on share-based payments. So it mandates companies to account for these expenses.
And we've come across cases, real-time cases where, and it's something that we wrote in the classic mistakes discussion as well, is of course the first mistake is kind of not following the right process. We'll come to that. But especially in startups which are growing very fast, hiring every month, giving ESOPs every month.
Right.
So they might have 3 grant dates in a month, 30, 40 grant date across years. So we practically come across cases where big 4 audit firms or big audit firms have said we need valuation report of each grant date. Why is that requirement coming in? And is there a way to mitigate that requirement?
Right. So again, the technical this guidance note of ICI as well as India's 102, they insist on having a valuation on every grant date. The logic behind that requirement is that the company share is not a static thing. The valuation keeps on moving either upward or downward. So on every grant date, you look at any listed company, the share price moves every day. But there is a value discovery process where
it is happening every day.
Every day. But in private limited companies, it's not possible. So if any auditor is insisting on having like 365 valuations date for every grant date in a year, they are mistaken. It's not practical. It's not possible to follow. So the practical way out of this mass is basically we can agree on say 2 valuation reports in a year, or if the auditors and the founders are of the opinion that the company's share price is moving or the valuation is moving very frequently because of external factors, or there are, let's say there's some regulation has come in, because of that the company's valuation must have impacted.
Right.
Say RBI comes up with a new regulation, and the company is a fintech company. So they foresee that my business is going to get impacted. In that case, they should go for a fresh valuation then. Right. Otherwise, 2 valuation in a year is more than enough.
Interesting.
So let's say you take a valuation on say 1st of April, which you can use for all the grants made between 1st April to 30th September. You take another fresh valuation on say 1st October.
Is it not 3 months now? The validity of a valuation report is...
there is no, as far as guidance note is concerned, it says on every grant date.
Right.
So now it's up to us. If we are saying that the company's business is very...
No, but when we talk about private, sorry, I'm cutting you. When we talk about private placement,
yeah,
maybe I'm not recalling it correct.
For the reporting purpose, FDI purpose, it's
3 months. That's the only...
Yeah,
okay,
that's the only thing. Like,
understood.
Why I'm going for 6 months time? There is a reason to it. I've explained that in the next question probably once you are asking me about the exercise and the valuation. But two valuation reports in a year would probably will suffice. Where you take a valuation report on say 1st of April, whatever grants you are making from 1st April to 30th September, you assume the underlying share price to be that valuation. You take fresh valuation on 1st October, and whatever grants you are making from 1st October till say 31st March of next year, you will assume share price to be based on that. And then rest of the things, the expense calculation, everything you should leave it to your valuers and the accounting team, of course.
So I have one question for Nitin here. So again, we all know Nitin comes with a valuer background, and valuation report is the bread and butter for him, right? So talking from a company's side, right? Why the company should approach for 2 valuation report, say half in a year, right? And I've seen the companies where auditor are not even aware that there is a valuation say report requirement, right? Or the auditor is been following the report which the company has raised the fund, say 2 years back.
Right.
So they've been following that, right? From a founder's perspective, if I'm going to you, right, you will be charging me some X cost, right,
Right.
to get that valuation report. So how will I come to you? And is there any some cases, right, where I can skip this valuation report requirement and my cost as well?
For a moment, Akash has become a founder.
Yeah.
It's a good thing. I mean, see, again, compliance is more of a preventive cost, right? And prevention is always better than cure. Remember that.
I hope
So-
it spreads out. Yes. Yeah.
So, I mean, after this PTM fiasco, where there were some lapses in the regulations and compliances, people are more aware of compliance costs now, or not following compliances as a cost. They understand this fact. So I agree with Akash. Let's say if the valuation, I mean, the fundraise has happened very recently, then you can base all your grants and valuation, at a price where, I mean, you already have a price discovery. Right? You can use that valuation. You need not get a fresh valuation done for shares. As far as options are concerned, you still have to, I mean, get a valuation done. Second part is, he said, at what point of time founder should decide, or the company should decide to go for a fresh valuation report, and for how many, I mean, in a year's time, how many valuation reports should be obtained? The answer is simple. You have to look at the business model. You have to look at auditors' requirement, discuss with them. Some auditors are reasonable, and if they see that valuation, I mean, business model is not changing very frequently, they might be, I mean, okay with single valuation report as well. So you can take a valuation report in the middle of the year and assume the share price to be the same for throughout the year. You can apply that. But I mean, again, it's a call. So look at the valuation models, revenue model, look at the regulatory environment, look at some externalities which might have an impact on your valuation, discuss with auditors. And finally, I mean, even from an employee's perspective, they might be interested in knowing what is the value of their options. So having a fresh valuation, kind of, you can always present it to the employees as well, saying that, your company earlier it was valued at 50 crores. Now it is, we have got a fresh valuation done. The fresh valuations giving me a say 120 crore valuation. They would feel, I mean, good about it. So I mean, there are a lot of factors which should go into this decision. And definitely, yeah, we will charge them.
The last point is still intact, status quo. So we have a lot left, and we'll try to summarize in next 10 minutes or so. We might go overboard. So if you have any questions sitting here, of course, we have people sitting, and we'll continue with them after the live as well. So if you have any live questions to ask, it will be helpful to people watching online. And if people who are watching online have any question, feel free to drop that in the comment box. Let's just try and summarize things and move forward with it. Now, in the same example, let's continue with this. We've talked about ESOPs theoretically, what documentation needs to happen, how valuation will take place. But at the end of the day, this is masterclass on cap table, right? So we've always been talking about fully diluted cap table. For those who don't understand, go watch our episode 1 and 2 on YouTube and LinkedIn. Now, you always talk that whenever you are giving ESOPs, the fully diluted cap table will assume that all ESOPs have been issued. But let's talk about audited financials or financial statement for external stakeholders. How will the cap table look like at year end, right? What are the variables we will be talking about, and how will that cap table take a shape? What are the disclosures? Maybe a little bit insight on that. Maybe not that technical.
Yeah. So you have to understand the regulators don't always catch up to the latest things. Sometimes they look at things from a legal angle, totally forgetting about the commercial angle.
Right.
So this is what happens in case of ESOPs as well. So in your financials, you will have a separate table for your equity shares. You will have a separate table for CCPS, preference shares and CCDs and all those things. So any user of those financial statements will probably have to go a step further to identify and see how many shares would get allocated against these CCPS and CCDs. So you will have equity shares, equity shares corresponding to your CCPS outstanding, equity shares against CCDs, and then look in the notes to identify the size of the pool. how many shares have been allocated or set aside as ESOP pool. So once they are trying to create a cap table, they should have equity share capital, converted CCPS, converted CCDs, and then ESOP pool to identify what is the total structure of cap table.
And when say in terms of ESOPs, what are the disclosures that are required? Does
So
the
yeah,
cap table or say my financials will show that story? How will that be depicted?
so yes, as far as the disclosure is concerned, the company will need to disclose again the cap table. Always the ESOP pool will come if there is any, right? And then your year-end financials will talk
Right.
about the ESOP disclosures that
Right.
that how many options have been granted during the year, vested, exercised, lapsed. This will all talk about. Then your board report, again the year-end board report, will talk about the ESOP disclosures.
So probably then we are saying that a fully diluted cap table will show full ESOPs,
Correct.
but then the financial cap table will only show shares that have actually been exercised and allotted. The rest of the ESOP scheme is more of a descriptive disclosures in either the notes or say a board report that comes along.
Correct.
Right. So I think that's where we will end the cap table discussion. But let's just talk about a little on classic mistakes that is happening in the ecosystem around ESOPs.
Right.
And I'll ask questions for that. Can my grant date be prior to my joining date? And have you seen such cases? What are the classic mistakes?
Of course not. Your grant date cannot be cannot be a date prior to your joining date. Your grant date will be your joining date or after your joining date only.
But can I have a grant date without the ESOP scheme?
So I think you are asking, can I have the grants without the grant letter?
Yeah,
So,
I mean, of course, I am a
Yeah.
layman. The only thing I have in hand is an appointment letter which says I'll have ESOP worth 30 lakhs. Is this the right way to do it? If not, what's the mistake we are doing in this?
so these are the general mistake where the founder doesn't have the policy, and while discussing the CTC part, the founder have committed some worth of ESOPs to you, right? And they have mentioned in the employment offer letter or say the employment agreement that you have worth X of ESOP in the company to you, right? So what I usually advise is to rephrase this line. That is not a correct way. That is for sure, right? You will need to have a grant letter or you will need to have the grant terms and conditions in the employment agreement included specifically that how many options, what are the vesting terms, what are the exercise terms, what is the exercise period, price, all of these needs to be stated in the employment agreement or a separate grant letter. That's the standard one. But since you don't have the ESOP scheme, but you want to basically promise in a document that the employee which I am hiring, right, he has got a confidence that he has been promised by a founder that he has got the ESOP in the company. So for that purpose, the company can phrase a line that you are entitled to have worth of this ESOP in the company as and when the company roll out the policy. So this is
It is similar to saying, can we occupy a premises without having a rent agreement in place? You can, right? But the idea is, if you, everything is agreed verbally. You want to have some documentary evidence to it. That's where ESOP policy comes in. So have a rent agreement first, then let the tenant occupy the premise. Once you get in the building and then the landlord says, you cannot use this refrigerator. It's a tricky position to be in. Right?
Interesting. Next would be that we talked about grant dates. What should be the frequency of grants? Once in a month, once in a quarter, once in 6 months?
It doesn't matter. If you want to give grants from the date of joining itself, you can.
So you're saying 365 days I can give grants?
Yeah, absolutely.
That's an interesting one. And then finally, and that's a question to you also because I have come across many, where books have been audited and after 3 years we get to know somebody said, where are my ESOPs? Now, how do you handle that situation? For 2 years, the even auditor was not aware there is ESOP. And the third year, an employee sends a notice, where are my ESOPs? Why does it happen and how can we protect it not happening?
So while giving the ESOP, the company and the founder, so should have this in mind that they should have the ESOP policy first in place
Hmm.
before they are promising to to their employees, or before they are granting us a verbally or mentioning in the employment letter, right? So they should have the ESOP policy, even if you have not issued the grant letter, right? But you should have the ESOP policy. That is very important. The grant letter, all of these documentation, right, can be done at later point of time as well. Accounting and all, that may or may not be manageable, right? But yeah, there are possibilities, there are cases which we have seen practically, right, where the policy was not in a place, that becomes a very difficult uh, case for the company, right, to tackle with their employees.
I will
Interesting.
answer this from an auditor's perspective.
Yeah.
So, I mean, there are 2-3 parties involved. One is founder, second is auditors, in your question, and third one is employee. If I'm an employee, I should make sure that I have got that grant letter. You can't simply go with founder's word. Right. You have to have some documentary evidence to it. Grant letter will definitely refer to some ESOP policy, because grant letter itself will not have all those terms and conditions. So you should, as an employee, insist on having a copy of that ESOP policy, which is something which, I mean, it's just like leave policy. How many leaves you will get? It is mentioned in the policy. Ask for policy then. So this is for the employee. For an auditor, whenever you are doing a startup's valuation, audit, you should always ask for shareholders agreement. Shareholders agreement would always have a fully diluted capital post investment, which would mention ESOP pool. If there is a ESOP pool, as an auditor, you should ask founder, where is the ESOP policy? And if ESOP policy is not there, get it done. If the grants have been made, you will come to know about it then. But if you're not referring to this shareholders agreement, you will sign the balance sheet without considering ESOP expense. And as you mentioned, 3 years down the line, somebody might simply wake up saying that we missed it. And auditor would say, I know, nobody told me. So ignorance is not an excuse. Auditor should also apply some kind of diligence there. Read SHAs, read cap table annexures, and ask questions.
Got it. There are two more, I think, full episode based topics, but let's just touch upon base. This was holding subsidiary relationships. What happens in case employees get shares of the holding company? So subsidiaries in India, as an employee of the subsidiary, I am getting shares of the holding company. Does that policy become part of the Indian subsidiary? Will the holding company have its own policy which will cover subsidiary? How will that function out? And let's just take the reverse example also, where India is holding and then there is subsidiary across the globe. Where is this ESOP policy domiciled? At the subsidiary level or at the holdco level?
Usually, it will be at the parent level.
Holdco level.
Yes, either it is outside India or it is India. But there are chances where the subsidiary is also creating value in the business itself. The company would have carved out a policy or say
Just for
ESOP pool
the
just for the
subsidiary
employees of the
employees.
subsidiaries.
Now, in that case, it doesn't hold good for the
Yes.
holdco employees, just the
That's correct.
subsidiary
That's
employees.
correct. Yes.
That's interesting. Now, in terms of taxation, which is something as a last topic we'll discuss because we are already over time. Let's just go back to our example. 2 years have gone by. My 30 lakhs worth of ESOPs are now all vested, now exercised. I've paid 30,000 rupees as exercise price. Is there any other obligation to me as an employee?
Very pertinent question, especially given the fact that Akash already mentioned about exercise of options. So exercise of options simply means that you're buying the shares now. And Akash mentioned that, companies can have this exercise period open. You have already completed your, say 4 years of service. Now you want to exercise, or you can defer the exercise till the time there is an event. Right? So my idea is company should have this exercise period open for the existing employees who are continuing in their employment. The reason is, think about a case, let's say 4 years have passed and your exercise price was, say 10 rupees only.
Yeah.
And you have got 100 options.
1,000 rupees.
Right. As per latest round of funding, the company's share price per share is say 1 lakh rupees now.
I wish, yeah.
So 1 lakh into 100, 1 crore is the value of your options. Your options are worth 1 crore.
Right.
And how much you have to pay to the company?
1,000 rupees.
1,000 rupees. So you have a kind of, I mean, I'm just rounding it off, you have a benefit of 1 crore rupees.
Right.
So what you do, you exercise these options. What you get in return, you exercise these options, company will give you a share certificate. Right. Now there is a person sitting on a chair in the HR, and that person is basically assessing officer. Right. He knew that you would come and exercise these options.
Right.
So as per perquisite valuation rules of income tax,
Right.
he would say that you have got the benefit of 1 crore rupees.
Yeah.
Right. 1 crore minus 1,000. I'm just rounding it off to 1 crore. On it, since you are in a highest tax bracket, you would be paying 30% tax on that. So what you do?
Almost 40.
Say 40%, including surcharge, etc., etc. So let's say 40% is the tax rate now.
40 lakhs.
So what he would have to do, he would have to pay 1,000 rupees to the company. At the same time, he would have to pay 40 lakh rupees to the tax authorities. Right? And that tax, it's not up to him. It's not up to you. I mean, it's up to the company to deduct that tax. So let's say he's already getting some salaries and TDS would be deducted out of that salary. TDS would include this 40 lakhs part as well. So he will not get salaries for the month of, say, December, January, February, and March. Right?
Work for
And
free for 10
he
months.
goes to his home, and parents and wife are asking, what you have got for us. So he would say, see, this is the certificate I have got. Right? I mean, benefit is notional. Tax liability is real. Right? So you have to differentiate between that. There is a notional gain of 60 lakh rupees after exercising, but that 40 lakh has gone out of pocket already. So one should try and defer the exercise till the time there is a liquidity event. Because once he has got those 100 options, 100 shares, he cannot sell those shares in the market because it's still a private limited company. So he should wait as an employee till the time there is a liquidity event. Means either company is getting, acquired by some other company is going for IPO. At that point of time, you should exercise. Exercise and get the money, pay taxes, and you are still left with 60 lakh rupees of actual cash.
Right.
That's why company should keep the exercise period open. And on employees' part, they should try and defer the exercise till the time there is a liquidity event.
I have so many more questions coming in, but one last I'll definitely ask. Continuing with this, Akash, in terms of exercise period, can it be variable for people who are already working, continuing to work, and people who've left? How practically you've seen, and what's the right practical approach to this?
So like Nitin has mentioned, right, the employee who has been continuing the employment, right, after the vesting as well, the exercise period should be open, right, to any time, right, to any event, right.
But what if somebody has left?
So yes, the company ESOP policy can restrict that period, right? Maybe 1 year after the resignation, maybe 2 years, maybe 3 years. Again, depend upon how the company wants to frame its policy, how friendly it will want the employee to basically attract, right? The policy needs to be say employee friendly in the early stages, or to basically attract the employees to accept the grant. So it all goes with your ESOP policy, and it can have different exercise period for different stages of employee who is in the employment, who has resigned, who has basically left the company. Yes.
Interesting. So finally, we have a fully diluted cap table. We've come across the third episode. Of course, there is so much more that we can talk about, but I think practically we have already broken down it in simple language. If yes, please do let us know in the comment box. We can leave our email ID in the comment box. Do give us a feedback. If you want us to break technicalities into simple languages, we'll be more than happy to take this forward. Thank you, Akash. Thank you, Nitin, for doing this. We'll end the live session here. Thank you so much for joining.
Thank you.